If you're an experienced trader that thinks a stock, index, or ETF is going to trade around a specific price or a very narrow trading range, and you are willing to accept a high level of risk and have enough capital to cover margin requirements, then you can potentially profit from the short straddle. The short straddle is created by simultaneously selling both the at-the-money call and put with the same expiration date. You receive 2 premiums from the short straddle when you execute your trade. Let's say option prices drop over time. You can buy the call and put back to close the trade at a cheaper price to lock in a profit. Instead of buy low, sell high, with a short straddle, you're hoping to sell high and buy back lower. Because you've sold options you did not previously own, meaning you're short both the call and the put, your risk is unlimited on the upside and substantial on the downside. Should the stock make a big move either way before you exit the trade, you will incur a loss. Keep in mind, this is an advanced option strategy that requires margin and has high risk. Assume that XYZ is trading at $100, and you don't believe it's going to stray from that price for the next few weeks. So you short the 30-day 100-strike straddle for a combined net credit of $6. Which is really a total premium of $600 per short straddle. The best case scenario would be to have the stock sit exactly at $100 at expiration. This is the only time when both the call and put options would be worthless and you would get to keep the full credit from selling the straddle. Many traders choose to buy to close both options prior to expiration and exit the trade. This will eliminate any assignment risk. As long as you can close the trade for less than the credit you received, you'll have a profit. If you have to pay more than the credit received, you will have a loss. Three weeks later, with XYZ sticking close to $100, the straddle has decayed significantly and is now valued at $1. At this point, you've got a $5 unrealized profit. You could then buy both options to close the trade and walk away with your $500 profit per short straddle. But if you felt that the stock was going to continue hanging around the $100 mark, then you could keep the trade open in an effort to draw out more profit as the straddle continues to decay in value. At any point before expiration, if the stock starts to move, you can buy to close the trade to avoid giving back any more profits or even incurring a loss. However, if XYZ moves in either direction through the break-even point, then the value of the short put or the short call can get quite expensive. If the stock happens to move significantly, your broker may require additional margin or more money in your account to cover this risk. Remember, your risk is unlimited on the upside and substantial on the downside. The closer the stock is to $100 at expiration, the better. The out-of-the-money option will expire worthless, and the option that's in the money can be bought to close. For example, if the stock closes lower at $98, then you can buy the put to close for about $2. The call expires worthless, and you're left with a profit of about $4. If, however, the stock moves higher to $108, then it would cost you about $8 to close the straddle, handing you a $2 loss or $200 per short straddle. Time to expiration will also be a factor in pricing. At expiration, the in-the-money option is going to have value equal to how far away the stock has moved from the $100 strike. If that move is greater than $6, the amount you collected selling the straddle, then you'll have a loss. The plan with trading a short straddle is to generate income from time decay. It is likely that one of the options sold will finish in the money and is subject to assignment. Therefore, if assignment is not desirable, buy back your short positions prior to expiration. Keep in mind that implied volatility plays a big part with the short straddle. You want it to decrease so that you can profit from both the call and the put. To learn more about the short straddle and other strategies, visit the OIC website at optionseducation.org.